What if I told you that you could take 4 times the depreciation on your property legally starting this year? Most real estate investors are leaving hundreds of thousands of dollars on the table because they've never heard of this. I'm talking about cost segregation. It's one of the most powerful tax strategies in real estate, and thanks to the new law, it's more valuable now than it's been in years. By the end of this video, you'll understand exactly what a cost segregation study is, how it works, and 2 important rules that can affect how much you actually save. Hey everyone, I'm Jeff, the co-founder of Proseer, a modern accounting firm supporting business owners to help keep more of what they earn. Let's break this down. When you buy a commercial building, the IRS says depreciated over 39 years. And for most investors, that's exactly what their CPA does. Spreads the deduction evenly over nearly 4 decades. But here's what they're missing. Your CPA is depreciating your building wrong. When you buy a commercial property, the IRS says it's depreciated over 39 years. But think about what you actually bought. You didn't just buy walls and a roof. You bought carpet, cabinetry, parking lots, landscaping, lighting fixtures, appliances, fencing, stuff that wears out way faster than the building itself. A cost segregation study is an engineering analysis that pulls those items out and reclassifies them into shorter categories. Think 5, 7, or 15 years instead of 39. And under the new law, the One Big Beautiful Bill Act, anything in those shorter categories qualifies for 100% bonus depreciation. You can deduct the entire cost in year 1, not spread it over decades, year 1. Instead of one slow deduction over 39 years, you're pulling a huge chunk forward into year 1. Same total depreciation, you're just getting it sooner when it's worth the most. Now here's where it can get interesting. Let me show you actual dollars. Say you buy a $10 million commercial building. About $2 million is land, which you can't depreciate. So you've got $8 million depreciable. Without a cost seg study, straight line over 39 years gives you roughly $500,000 in depreciation over the first 3 years. Now, run a cost seg study. An engineer identifies $800,000 in personal property and $800,000 in land improvements. Both qualify for 100% bonus depreciation, which means all $1.6 million can be deducted in year 1. Total depreciation over 3 years, over $2 million. And that's 4 times more than just a typical straight line over 39 years. And here's something many real estate owners don't realize. A cost segregation study on a $10 million commercial building can turn $500,000 in depreciation over $2 million in those 3 years. Same property and the same price. The only difference is an engineer identified which parts qualify for faster write-offs. And at a 37% tax rate, that extra $1.5 million in depreciation sooner translates to over $500,000 in tax savings today. Not theoretical, money you get to keep right now. And studies for these types of buildings can cost $8,000 to $20,000. So you're spending this money, but saving $500,000 in taxes. And that's a really good return on investment if you ask me. And those numbers scale. Manufacturing facilities typically reclassify 20 to 60%, restaurants 25 to 35%. Even apartments and offices can come in at 10 to 20%. There's almost always money to be found. Now I want to be upfront because I'd rather you hear this from me than get surprised later. Cost segregation is powerful, but here are a few situations where it might not be worth it. First, the excess business loss rules. If your business losses exceed $313,000 if you're single or $626,000 if you're married filing jointly, the IRS won't let you use the extra to offset wages or capital gains this year. It gets pushed to next year. Giant deduction doesn't always mean a giant tax break this year. Second, you might not have income to offset. If your rental losses are stuck as passive losses, the extra depreciation sits unused. Third is if you're selling soon, due to a concept called depreciation recapture. This is effectively a rule that counts all the depreciation you took over the life of the building before you sold and calculates a gain on it. And here's the part that many people get wrong. Not all depreciation recapture is taxed the same. The building itself maxes out at 25%, but items that cost seg reclassified, such as carpet, cabinetry, certain land improvements, those can get taxed at ordinary income rates. Now let me unpack those 2 last points. On the excess business loss rules, the One Big Beautiful Bill Act just made it permanent. So here's what that means. Your business losses can wipe out your business income, which is great. But once they go past the threshold, the government says you can't use extra losses to offset your salary, investment income, or capital gains in the same year. It becomes a net operating loss carry forward. So if you're a married couple, you do a cost seg that creates $1 million loss, and you also sold stock for $1 million gain, you might expect those to cancel. But $374,000 of that loss gets blocked until next year. That's a timing difference, and it matters for estimated taxes and cash flow. And on recapture, there's two different types, and here's why they both matter. When your cost seg study reclassifies building components into faster categories, some of those items become what the IRS calls Section 1245 properties, things like carpet, cabinetry, and lighting. When you sell, depreciation on those properties is recaptured at an ordinary income rate up to 37%. The building structural components are Section 1250 property, and that recaptures at a max of 25%. So does that mean a cost seg was a bad idea? Not at all. You still got the time value of those deductions earlier, but it means you need to plan for it. And your advisor should model this before you list, not after. And one more thing, you don't have to do a cost seg study the year that you buy. If you've owned a building for years, a look-back study lets you claim all the missed depreciation in one shot. No amended returns, one filing, one catch-up deduction. All right, let's bring it together. 1, cost segregation reclassifies part of your building into shorter depreciation categories. And with 100% bonus depreciation now permanent, you can deduct those amounts immediately. 2, watch the excess business loss rules. If deductions blow past this threshold, the extra gets pushed to next year, not a current tax break. And 3rd, be careful of depreciation recapture. You need to plan for it and make sure you have the right advisor that can understand how different assets get recaptured. If you own commercial real estate and want to know whether a cost segregation study makes sense for your portfolio, head to proseer.co. We're happy to evaluate your properties and show you the numbers. And if this video was helpful, please like and subscribe. We're constantly sharing tips for business owners like you, and we love to keep in touch. Talk to you soon.